Namaste and greetings. I'm Mahima Kapoor, researcher and assistant editor at IMPRI, Impact and Policy Research Institute, Prabhav एवं नीति अनुसंधान संस्थान नई दिल्ली. Welcome you all to the IMPRI hashtag Web Policy Talk. The COVID-19 pandemic has inflicted heavy economic costs across the world, with countries reeling under recession. Certain structural reforms, such as the National Monetization Pipeline, National Infrastructure Pipeline, PM Gati Shakti, Production-Linked Incentive Schemes, PM Garib Kalyan Yojana Package, Atmanirbhar Bharat, among others, have helped mitigate the effects. To evaluate the way forward for long-term economic expansion, we have gathered for a talk under the series, The State of the Economy, hashtag Econ Dialogue, with Dr. Renu Kohli on India, Growth Prospects After COVID. This deliberation is being organized by the IMPRI Center for the Study of Finance and Economics. I feel honored to introduce the chair, Professor N R Bhanumurthy. Sir is the Vice-Chancellor at Dr. B R Ambedkar School of Economics, University, Bengaluru. He has worked as a macroeconomist at UNESCAP, Bangkok, and UNDP Regional Center for Asia Pacific Region, Colombo. He has also worked as a consultant to ILO, UNDP, the World Bank, and the Asian Development Bank. Sir has published extensively in various economics and finance journals. His books include Financial Access in the Post-Reform India, Economic Growth, Employment and Poverty, a study of manufacturing, construction, and tertiary sectors in India, Implementing Monetary Consensus in the Asia-Pacific region, Achieving Coherence and Consistency, among others. Welcome, sir. I feel privileged to introduce the speaker, Dr. Renu Kohli. Ma'am is an economist specializing in Indian macroeconomic and financial sector issues, on which she researches, consults, and contributes regular op-eds. A former staff member of the RBI and IMF, her research areas include capital account liberalization, exchange rate management, monetary policy, financial sector reforms, and international economic policy coordination. She has published in refereed journals such as the Review of Development Economics, Journal of Development Studies, Journal of Asian Economics, and has authored India's Experience with Capital Account Liberalization. She also serves as Independent Director, NCML Finance Private Limited, and member, CII Economic Affairs Council. Welcome, ma'am. We are fortunate to have Dr. J. Dennis Rajakumar, Dr. Radhika Pandey, and Mr. K Arun as the discussants for the session. Dr. Rajakumar is the Director, Economic and Political Weekly Research Foundation, Mumbai. Welcome, sir. Dr. Pandey is a Senior Fellow, National Institute of Public Finance and Policy, New Delhi. Welcome, ma'am.
Thank you.
Thank you, ma'am. And Mr. Arun is the Consultant Editor of the Economic Times, New Delhi. Welcome, sir. Now I invite Professor Bhanumurthy to take the proceedings further, and we look forward to learning from our esteemed gathering. Thank you.
Thank you, Mahima. Can you hear me?
Yes, sir, we can.
So first of all, let me thank IMPRI for inviting me to chair this session on India's growth prospects after COVID. And especially, I'm doubly thankful for you for asking me to chair this session, especially when Renu Kohli is speaking. Renu has been one of the important commentator on Indian economy. In fact, her works on capital flows even today has been a Bible for many of us, and it has been included in many of the curriculum in leading institutions. And we still read that book, and I must thank Renu for that work. And I do hope that we'll have a second sequence of that book now that it's 15 years now. And you have already written that we have to really relook at Tarapur committee I think maybe you also need to relook at that book so that we will be having some updates on the capital flows. And it's very important for us at the moment. And I'm also thankful for because all the discussants are somewhere or other, they're my colleagues and they were my acquaintances, and especially people like K Arun. I've been reading his work for almost 20 years now and continue to read. And Dennis, again, he's heading very important institution, EPW Research Foundation. If the youngsters who are here, I think EPW Research Foundation's contributions to economic research, I think needs to be really highlighted here. And Radhika, she's my colleague from NIPFP. And again, she has been very actively participating in the debates on Indian economy. So more than all these things, I think I'm more happy with the topic. Although we are facing this third wave, now we started talking about post-COVID economic growth prospects. So that means we seem to be seeing the end of this pandemic, and that's a good news. And although we have a budget coming in the next 10 days, unfortunately, we all keep talking about very short-term perspective of Indian economy. So I guess Renu is going to take a little longish perspective on Indian economy. And we completely forgot about the issues related to India's potential growth, or what is the medium-term policy challenges, and what needs to be done really to improve the potential growth of this country. Like many have been writing, that potential growth must have come down drastically in the recent period. So I hope Renu will take a very broad perspective and what needs to be done if we really want to improve potential growth of this country, and what are the macro policy challenges that we need to have for increasing the potential. And of course, there are a lot of reforms that have already happened. Maybe we need to see how that's going to be implemented. But having said that, I'm extremely happy that this session is going to happen now, and keenly waiting for listening to Dr. Renu Kohli. Thank you so much. So over to Renu.
Thank you for a very generous introduction, Bhanu, and I'm not certain whether I deserve all of it. And pleased to meet everybody. And let me start with thanking the IMPRI, the acronym is easier to speak out, and for this opportunity, because as Bhanu pointed out, everybody is very curious to know what's going to happen and what are the prospects over the medium term, because everybody knows that the recovery, a bounce back from a very deep contraction as we had last year, it's fairly straightforward, and therefore it's very hard to see beyond that. Without wasting more time, I'm going to start sharing my screen. And I don't have a very long presentation, but I thought it would be nice to anchor some of the points, and then I will expand upon them. And Arjun, please feel free to just remind me in case I overshoot.
Sure.
Okay. So with that, let me begin. I cannot, can everybody see it?
Not
No.
yet. Not yet.
No? Is the screen visible to everyone?
Not yet.
Sorry, is the screen not visible?
No.
Now?
Yes,
Yep.
now we can see it.
I think I just press share.
Yes, it's working.
Yeah, okay. So let me start with this current optimism, as Bhanu noted, that the third wave is continuing, and yet everybody's talking about recovery. And that's correct, absolutely true, because we did see signs of a bounce back from the last quarter onwards. And we can see the recovery signs all over the world. And somehow the arrival of Omicron has not dented enthusiasm or prospects, and neither has it actually derailed or sort of, prevented economic policies all over the world, actually, from beginning to move towards normality. And so in that sense, there is a decoupling of the pandemic with the policies. So coming back to India, there is there is actually a great deal of optimism about the post-COVID recovery and the medium-term growth prospects. And one of the a key measure of this is that while the advanced estimates and most analysts peg the recovery in FY22 from anything, the range between 8.5 to about 9.5, some even 9.7. And now recently there have been some downgrades for the last remaining quarter on account of damages caused by Omicron. But everybody has that. And beyond that, for FY23, the common projections for growth are anything, the consensus lies between 7 to 7.6%. And most analysts peg the medium-term growth for expectations around the range of in the 7% region. Now, so the question is whether these are realistic estimates over the medium-term prospects, or do we have reasons to be cautious about India's medium-term prospects? I would argue that one needs to be a bit more cautious because for two simple reasons. One is that during COVID, we have seen, starting from its arrival in the early 2020, that the forecast errors that COVID has induced have been very large. All over the world, globally, we found that the growth forecasts were really belied by the bounce backs 6 months or 8 months later. And so they were, particularly gloomy to start with. So the forecast errors have been very large. Second is that the COVID damages have been quite high. And then last of all, most important, it's very hard to find visibility about the nature or the strength of demand because COVID has induced many distortions in the data. And the reason for that is that there is about 2 or 3 strands of demand which are coming together on reopenings all across the world and in India. There are differences in the extent of stimulation that advanced countries have given and India has given. And therefore, that makes a difference to the suppressed demand that could not take place or people couldn't spend because of the pandemic. Second is also because the reason is that demand has also been bunched towards just goods for a long time. And therefore, there is this pent-up demand for services. And last of all, we do not know exactly, at least in Indian case, as to what is the true strength of demand, because that takes us to the second major factor why we should be cautious, why perhaps caution is required, is on account of the pre-COVID economic health. That itself raised concerns before the arrival of COVID. And we go back to the output collapse in FY20, that is the year 2019-20, when growth actually suddenly collapsed to 4.1%, and to just about everyone's surprise, it was hugely unpredicted. Why does that matter, the economic health? Because, and the output collapse in that year. I think that it matters because the causes or the reasons for that collapse, sudden collapse, are largely remain undiagnosed and poorly understood, partly because of the short span of time and partly because COVID has also distracted our attention and focus from that. Because the reason why it is important is that if it was coming after it was a third year of a slowdown and a sudden collapse, we do not know whether it was cyclical or structural, and the reason why, if the drivers of that economic weaknesses were structural, then there is a risk that the potential growth could have been shrunk as a result, it could have contracted. So in case if the potential has been damaged in 2019-20, then the return to a high growth trajectory in the post-COVID period might be difficult over the medium term. It might be a very Herculean task. A short recapitulation as to what had happened actually in 2019-20. If we go back and recall, then the year actually started with very great deal of optimism in early 2019. For example, common predictions of growth in that year were between 7 to 7.5%. Some even had it higher, some analysts. For example, if we remember the RBI forecasts in February 2019, that is the first monetary policy review of that year, post-budget, the RBI's forecast was 7.4%. And then consistently, the RBI actually pruned it down to 5% by the end of the year. And whereas when the actual outturn came, it was 4.1%. So it was a shocker. And everybody, no one expected it. How did the year unfold? It had unfolded with a great deal of optimism. And then suddenly, mid-year, the May or the June survey, that is before the budget, because it was an election year. So the RBI's Consumer and Industrial Outlook survey showed a huge plunge in expectations. It was the third biggest plunge ever, counting back to the year that the surveys began, I think 2002, and then partly they were revised and made much broader around 2005. And the previous two plunges, one was the dot-com bust, very identifiable with the economic shocks. 2001 was the dot-com bust and the tech bust all over the world. 0809 was the global financial crisis. But the curious thing is that in 2019, there is no identifiable shock. And yet the forecast error was as high as 340 basis points. So it is one of those unexplained things that have remained, and it is a serious issue because unless we know exactly why did growth collapse and what are the root causes, whether structural, cyclical, or whatever, how do we move ahead? How do we predict? And what's going to happen ahead in the medium term? What happened officially, if we see towards when the sentiments plunged in 2019, the RBI's annual report, which was published the annual report is published with a lag in the middle, usually on the 30th of August of each year, and it refers to the preceding financial year. So this annual report in August 2019 referred to the year 2018-19. But it raised an existential question because there was a lot of talk about the slowdown. The slowdown was occurring in the economy from 8.3% peak in FY17. So, growth slowed down to 6.8, 6.2, and so on. I think there were about many quarters of slowdown. The peak was really the last quarter of the demonetization year, or even before that. So the RBI raised an existential question asking whether the slowdown was a soft patch, was it a cyclical downswing, or a structural slowdown? And then that time the conclusion was that we need to wait and all that. By next year, actually, by the time COVID had struck India in March 2020, and the next annual report, which actually referred to the FY20, the output collapse year, the RBI glossed over that question of the soft patch, cyclical or structural, but it concluded that it was a confluence, the growth slowdown in FY20 was a confluence of a combination of cyclical, domestic, as well as global factors. Likewise, if we go back to the economic survey in FY20, the economic survey too expressed confidence that growth would revive in the second half of that year. But then after that, it never revisited the topic because growth actually consistently denied the projections, and the last quarter of FY20 actually fell below 3%, it was as low as 3%. So the question then arises that if it was cyclical, why did macroeconomic policies fail to reverse the downswing? Monetary and fiscal policies both had been easy In particular, in that year, budget of February 19 had actually used the escape clause under the FRBM and in the same, even saying that these were the reforms, the corporate taxes had been cut, and therefore it was a kind of a crisis in some extreme emergency, and expanded. So, both easy monetary as well as fiscal policy should have been able to reverse that downswing. But the fact is that it happened. In FY20, all three components of demand had decelerated: private final consumption expenditure, fixed assets creation, as well as exports. But it is the sharp breaking of private consumption that became the major focus of concern. And the reason for that is that the private investment shortfall was dating back to the year 2012. I mean, it never really recovered after the 11-12 slowdown. And Indian exports have always been subject to the external demand swings, and therefore external demand had not really been very great after the slowdown in world trade from 2012 onwards. So the issue in question in everybody's minds had been that, was the private consumption slowdown temporary? Was it accentuated, as the RBI FY20 report identified that idiosyncratic events such as new emission and axle norms hurt the auto sales sector, and NBFC credit plunge that had been, following triggered by the ILFS default in September 2018. So there were many speculated reasons, and amongst these, besides these, also whether high real interest rates from more extensive monetary tightening relative to inflation in the past, debt fuel growth, peaking of demand, sentiments, animal spirits, for example, had been dented by tax aggression, demonetization, the advent of reforms such as GST, IBC and RERA, the drag from that, twin balance sheet stresses, that is corporate and banking sector, adverse external environment, but NBFC crisis. So nothing remains settled, and the issue remains unsettled until now. So therefore, what we find is that we would say that the consumption slowdown is preceding the COVID shock, and then comes the COVID shock. The early assessment, again, it clouds of the preceding consumption because of the COVID has, as I mentioned earlier, has distorted demand patterns, in particularly supply chain problems in semiconductor chips and impact on car manufacturing, for example. It's very hard to assess that because we don't know. Car sales will revive soon or delayed, and then too, when the recovery happens, it's very hard to disentangle the two portions of demand. What is the backlog of orders, etc. And then there is this inverse correspondence in the two-wheeler sales, where the decline indicates that there may be such structural distress in the rural segments, despite the robust growth in agriculture. There are also many other signals which suggest that there is kind of persistent stress in the economy, and particularly in the informal economy. But if we look at data, hard evidence, we could say it's possible to have a narrative of signs of structural weakness. For example, the National Account Statistics shows that the aggregate household balance sheet stress was visible. Financial liabilities, that is borrowings by the households, they contracted by nearly 15% in FY20. And this contraction came atop an astounding 60.2% growth in 17-18, which itself was a threefold increase over the 22% growth in FY17. So certainly there is evidence that consumers are preferring to retire debt over current consumption in the year starting FY20. So if this, so one question is that if this consumer trend of consumers or households continuing to repair their balance sheets, then in that case, post-growth COVID revival would take a while, and it is hard to predict as to how long it can take. It can take, it is actually linked to income growth. The consumption is hugely dependent upon that, and it's one of the biggest drivers. So in a sense, this balance sheet effect upon the households and leading to a consumption slowdown is not surprising, because it was preceded by a very prolonged shortfall in private investment, almost a decade back. And that, of course, if there has been no investment in the economy, it impacts job creation, income growth, and it retards consumption. One could argue, or a counter question or to this story would be that why did consumer spending take so long to slow down? So let's refer to economic theory and the role of income expectations. Basically, the permanent income hypothesis also revolves around that consumers, if there is a shock to income and income falls, consumers take a while and they are more inclined to consider that the fall in income would be temporary, and they can continue to perceive that it's temporary. And this hypothesis owes itself to Friedman, and consumer studies, empirical studies have shown that the realization that the income fall shock is not temporary, but there is a permanent fall in incomes can be roughly about anything between 3 to 5 years, which is the medium term. So one could say that the future income expectations is important, and perhaps that accounted for the propping up of consumption, that it did not, it took about so long following an investment shortfall to slow down. It could also be the case that borrowings help sustain consumption. As we saw in the preceding slide, I showed how much the borrowing in the aggregate household borrowings had increased, 60% upon 22%. There was a sharp increase also post-demonetization, which is visible in the financial sector data in real lending from the NBFCs. So it was always such an unbridled boom is always unsustainable. There's enough empirical evidence to show us that. And it was, the party was headed for a crash as it did. And perhaps, there may be similarities between that crash in consumption borrowing, consumer borrowings, as happened in the case of bank credit to infrastructure, that boom to bust pattern of 2011-12. We do not know. Time will tell us. And perhaps when the bust happened in terms of borrowings, the realization amongst household in the aggregate is the confrontation or realization that what they were thinking, that it was a temporary income shortfall, is perhaps permanent. And once they confront weak future income prospects, then perhaps the plunge in sentiments happened in mid-29, and that triggered cutbacks in current consumption. So if that is the case, then that's one factor to be reckoned with as far as medium-term growth prospects are concerned. A second could also be the reason underlying the consumption shortfall could also be the reversal in terms of trade. We all know that Indian economy benefited enormously from the oil and commodity prices collapse from 2014-15. It also coincided with a period of very low inflation. So therefore, there is a boost to real incomes from all sides, whether it's households, that is consumers, producers, and the government in terms of tax revenue. So the entire economy benefited. But that phase tapered off from FY17. And then since then, from 17-18 onwards, we can see that inflation, particularly core inflation, has been creeping back. It has remained stubbornly between, about 5.5% and inched closer to 6% since then, despite the fact that growth has been falling since then. So, that's something which tells us it could again reflect a shrinkage in potential output, or meaning that the output gap is actually much smaller than it is perceived to be. It could also be indirect tax hikes in the Indian economy. Since FY17, we have had enormous hikes in indirect taxation, GST, excise, customs duties. A lot of tariffs have been raised from February 2018 onwards, and that may have worsened matters, eroded purchasing power, and dented consumer confidence. So, here we can consider perhaps the role of economic policies. It often happens that following a crisis, say like if we revisited the 2008-9 crisis, following crisis, the falls in output can persist. They can also turn permanent, and particularly the role of economic policies then assumes a great deal of significance in that context. context. And so, econometrically also, the presence of unit roots in GDP also reflects that shocks to output can be permanent. So the critical and relevant question to come back is that come back to is if consumer demand is poised to revive ahead, because that is where we are centered, and everything depends upon that in moving forward. We do have a stasis as far as investment is concerned. We also have very little space in policies. I'll come back to that, but let me just examine the evidence on consumption. What is the evidence on this so far? Up till now, there is little evidence, including in the post-recovery phase, the last few months, particularly the last quarter, where consumer sales have not really been as per expectations by most companies. But hard data, that is financial sector data, shows us that real credit by banks and NBFCs has hardly moved. In real terms. It's below 1%. And at the macroeconomic level, the sense that we get is that both producers as well as consumers seem to have used the ultra loose monetary policy for repairing their balance sheets. And it is well known that corporates have either swapped loans with cheaper funding from the market, that is the large firms, or they have retired their existing debt. Households, as I showed earlier, have also been doing the same. The quarterly savings data also, which is a bit volatile, and therefore, we have to await the national account statistics in that regard context, but it also reflects that consumers have not been spending. So the question is that is a stopper. It's an obstruction to the revival of private capex, simply because if businesses don't see demand, why should they spend and take risk? So that bears upon the near as well as medium-term revival prospects. I think most forecasters do not expect private capex revival, and that is building up an argument towards greater fiscal stimulation. But final question is that we do not, the least examined actually, is where if the damages to informal economy post demonetization and GST did contribute to the consumption slowdown with a lag. And that raises again the question about policy mistakes or mistiming policies. A lot of people have been commentary has focused exposed given the tepid outcome of GST, and they have said they have argued that perhaps it was not properly timed and it should have been timed at a time when the growth cycle was on the upswing rather than in the downswing. But we do not have too much of data to substantiate, and one of the hard indicators about consumption were the consumer expenditure surveys. But the status of that is we last have the consumption expenditure that at the household level or average Indian, median Indian in 2011-12. The leaked report, of course, did show that there was actually a fall in monthly private consumption expenditure in real terms. There are also some telltale signs in the labor market. For example, the number of workforce engaged in agriculture has gone up, according to, as per the PLFS surveys. Also, we find that from the CMI surveys that the reduced number of earning members per household. So these are some telltale signs, but overall hard evidence which could inform economic policy is lacking. There has also been less effort, I would say, official effort to get this kind of information or so that brings us to what are the post-COVID growth prospects. So essentially, we go back to where I started with the optimism and the projections. Now, the optimism, what is at the basis of these optimistic forecasts of 7% and all in the medium term? One can highlight, and in terms of points, which is the supply side reforms in the pre-COVID years, that is IBC, GST, etc. Many say that they've already begun to yield results. and more will follow, and that the reforms itself usually take, structural reforms take about a decade to yield dividends, or at least, about 7 years. And so it's about time. In the future, they will start, near term, they will start accruing to the sovereign and to the nation. More structural reforms have been announced and implemented during COVID. The status of these reforms, yes, but we can say certainly these are very positive forces, and they ought to boost consumer sentiment. Right now, because it's very early days, we do not see any substantial increase in consumer sentiments and expectations or perceptions about their future income. The RBI's latest consumer expenditure survey, which dates to November 21 last year, it is yet to reflect any great robustness, because they are indeed directionally, they are on the upside, but then they are emerging from their post-COVID lows, and the pace is the recovery of the expectations or sentiments is actually very, very lukewarm. On the reform side, again, there is some bit of reason to be cautious, because we've had rollback of the agricultural laws. There are also signs that the labor laws and the codes that were revised and all the rules have not been notified, and there is delay. And that gives rise to suspicion whether these are becoming politically difficult. IBC has been on the back burner for almost 2 years now, and increasingly banks are following other routes, including write-offs. And the latest is the bad bank seems to have hit hurdles in terms of the structure of its creation, which is surprisingly actually contrary to the existing Sarfazi Act. And that's actually a very shocking thing to happen, to realize after creation of a structure. The headwinds, and we do not know at this point whether these are temporary headwinds or they are more lasting in nature, is the terms of trade are turning negative. For all we know that these global growth may not sustain and prices may collapse, and therefore, the rise in oil prices, etc., may not be as harmful to the economy, and we could probably have better terms of trade. But as of now, it seems that alongside the pandemic-led damages to supply chains, the terms of trade reversal is not, it's moving against India's favor. And then the elevated inflation is hurting consumer confidence, because the consumer demand is so very depressed. The risk of high consumer prices or food and fuel, particularly denting consumer demand, is actually quite high, and it's increasingly becoming so because households have lost a lot of income, many households. A recent report by Oxfam also points notes, of course, measurements are difficult, but there is some credence to the facts and some anecdotal as well as, micro survey evidence to show that household incomes have generally fallen quite significantly. The recovery data also, the advance estimates also point towards that consumption is way below what it's about, just 97%. It's expected to be about 97% of what its level was in FY20. So there is a lot of depression there. The biggest constraint is also fiscal, because if we have to revive consumer demand, and if private capex is not going to, it's not getting encouragement or seeing visible demand on the horizon, then obviously there is a huge role for fiscal policy out there. The problem is that India's debt, particularly post-crisis, has shot up to 90% of GDP. And no matter how we stretch and comb and cut corners, there is no fiscal space. There is little to none fiscal space, and it's a very binding constraint. It's also a binding constraint which is becoming increasingly more so because the external environment has become very unfavorable. Unfavorable in the sense that apart from the reversal in the terms of trade, There is also very hard evidence that the US will start tightening monetary policy. It's a matter of the timing or the path may be unknown, but as many as 4 interest rate increases are expected next year, this year in 2022. And such, that always places emerging economies at the most severe risk, including India, and if oil prices are moving in tandem. So these turn off in the external environment always binds policy discipline much more significantly. Policies just have to be very, very foolproof in order to not expose or incur any kind of macroeconomic vulnerabilities, which could expose India to more instability. There is also the pressure of medium-term consolidation. The risk here is that until now, and even now, globally, markets as well as investors and international agencies, including governments, in general, there are what you would call the pandemic reprieve upon policies. There is no guidance or advice. Everybody's fiscal position, global debt is at unprecedentedly high levels. Fiscal positions are adverse everywhere, all across the world. And therefore, you could say that the threshold or the bars for fiscal repairs and all as of now are certainly, extended. No one expects very hard fiscal consolidation, and including the IMF, its advice is to go slow. But at the same time, the question of medium-term consolidation to rule out the adverse effects of crowding in, etc., particularly if private demand were to revive, these are questions that can no longer be dodged by India. And therefore, even if the government were to expand public spending, I think given the extent of the depression, this would be very low, would have to be very, very minimal. So then the other is the compelling of RBI will also, it's already been normalizing policies and it will increasingly move in that direction. We do not know. It does expect inflation to come down from the middle of the next year, this year, sorry, and keep being rooted in 2021. So we come to the cloud, the silver lining in amongst all these clouds, which is exports. There's been a performance has been stellar this year. And from all accounts, exporters have still many more orders in the pipeline. World demand has been good. The problem is that, not problem, but all EMEs have exported very well, and some like China, Vietnam, etc., have outsurpassed many others, and including India. So the sustainability of exports and the external demand is subject to uncertainties at this point. The popular belief is that the US Fed has lagged so much and is so much behind the curve in terms of tightening that just the monetary policy catch up in the US risks, threatens, may imperil growth, threatens the risk of sliding the US economy into a short recession. We do not know how whether the landing in the US will be hard or the Fed can achieve a soft landing. But the fact of the matter is that China is slowing. That's another. So two of the largest economies, the US is uncertain, but China is visibly slowing, and it has already been struggling to get back to its pre-pandemic growth rate in the last quarter, although in 21, it grew at a robust 8.1%, but in the last quarter, growth has fallen back. And not just that, its retail sales are still below the pre-pandemic levels. So there is a concern about China. And certainly, if two large economies slow down, Indian exports do face that kind of uncertain headwinds. The second is that we are not sure about global inflation. There is two camps, team transitory and team permanent. But beyond that, the real issue is that there were structural forces in the 2000s which actually repressed global inflation, kept it very low. These forces were technological changes, demographic changes, globalization. But now some of these forces are in reversal. Particularly, there is a deglobalization. There is many countries, in fact, the large ones, especially the large nations, have been increasingly resorting to activist and more interventionist industrial policies. Governments are also turning pro-labor, which means that encouraging increases in wages so as to rectify the depression in real wages or stagnancy of real wages that is suspected to have been unleashed on account of technological change, the relocation of manufacturing from across the world to places with the lowest labor costs and so on. There are also new forces which could keep inflation elevated, which is to do with climate change and the fast-paced transitions, energy transitions happening in some of the countries, particularly the large and advanced nations. So, of course, we have to see whether Indian competitiveness can overcome these factors and override these obstructions. The past is not too encouraging. Because typically India has not managed to keep abreast of competitiveness gains of the kind that displayed the nimble-footedness by countries like Vietnam, Bangladesh, and so on. So who knows, but we could maybe perhaps turn the tide. So I think this is the last slide. And so the conclusion is that COVID is already weakening the already fragile household balance sheets, then serious headwinds from demand constraints. External demand is iffy. As of the moment, it seems very good. If these are the forces and if it's the structural forces that are underlying India's economic growth, potential output has indeed shrunk, then in that case, getting back to a higher growth trajectory could be a distant and long-term call. And I will conclude at this point with thanks to all, and I welcome comments from everybody. May I continue to share the screen in case anybody wants?
Ma'am, you can.
Or should I stop the share?
Yes, ma'am.
Okay. All right.
Yeah, thank you so much, Renu, for that very lucid and very. In fact, you have raised so many questions. I think we still don't have many answers, I guess. Let me go to the discussants. Can I request Mr. Arun?
So please unmute.
So whenever I listen to Dr. Renu Kohli, I find myself in agreement most of the time. Here also, except for the last panel, I would agree with her in total, everything she has said. But I think the global prospects are slightly more positive than what she apprehended. In the first place, I don't believe deglobalization is going to happen. The global economy is actually integrating ever more. Even after the rift between the US and China, US financial institutions have been allowed greater sway in the Chinese financial system. All the major merchant banks in the US are now vying for a pie in asset management in China, and the Chinese government has allowed them to move. In 2021, China's trade surplus is some $876 billion. Their exports total to $3.6 trillion. So these are not signs of any deglobalization, but of aggressive continuing globalization. Now, if you look at the larger picture, some $14 trillion worth of additional liquidity has been created to fight the worst effects of the pandemic. Now, even if rates are going to be increased, raised probably 3-4 times globally, all that liquidity is still there. That money has to be deployed somewhere. And if we can create a policy framework that can absorb some of that capital, there's no way that capital will not come to India. And energy prices, well, of course, oil prices are being kept artificially high by production curbs in OPEC and Russia. But that might not be sustainable endlessly, because they themselves know that while it is good to try and harvest the high prices while the demand is still strong, if you keep raising prices to a level where that kills off their growth and therefore demand for their product, they know that will not be helpful for their own state budgets and their oil revenues. So beyond a point, a production that is constrained artificially will not stay constrained forever. It should, the supply should be forthcoming. And if the Iran nuclear deals come through, that is an additional supply, probably 200, 300,000 barrels per day, which will come on stream. So the global environment, as far as I'm concerned, is continue to be one of strong export growth or strong capital supplies and of relatively moderate interest rates even now. The question is, are we in a position to leverage this for our own domestic economy? Now, I think, again, while there are very serious constraints, I don't think that constraints are, such that they cannot be tackled. Yes, our banks have been very reluctant to lend for the last few years, but they have, although their gross NPAs have come down, that is because the RBI has halted asset quality recognition. They've given some moratorium and recognizing bad loans. So once that is resumed, I'm sure the bad loan portfolio will go up. So I think some serious financial engineering will have to be done by the government to enable the banks to start lending again. Now, one positive feature of the last couple of years has been the sharp surge in the volume of debt raised from the bond market by companies, which has been unprecedented. They have been issuing debt and their people have been buying it. While we still don't have an actively traded debt market, raising debt by issuing commercial paper and bonds has really become active over the last couple of years. And this is a very positive trend. I think that will continue. Now, as a result of the pandemic and the pandemic-induced slowdown, a large part of the small and medium enterprise universe will be in serious problems right now. Now, the question is, how will you allow them to revive operations? If they are constrained by their unmet financial servicing obligations to whoever they have borrowed money from, whether banks or non-banking financial companies or politicians with money to spare or whatever, they will not be able to come back on their feet. So they have to be given some serious financial relief if they have to be able to start working again. Now, why should they be able to start working again? Is there any revived economic momentum for them to start producing and feed that growth momentum? I think there is. For example, if you look at the gross fixed capital formation figures, for the first time, they are on the uptrend. And the figure for the last quarter actually are much higher than for the year as a whole, which means this is going up. The import of capital goods has been more than a double-digit rate for the last months for which data is available. So while our trade deficit has been going up, people are consuming more, high-quality gourmet food and all that in the past. In the last 6 months or so, our trade gap and the current account gap is being driven by a rise in capital goods imports, which is a very positive thing. And if you look at the trend in cement prices, steel prices, and so on and so forth, while they have come down most recently, there is some presumed uptick in their demand. Companies like Tata Steel, they have been able to pay down some 20-30,000 crore worth of debt from their operational revenues, and not just from substituting one kind of debt with the other kind of debt. So there is some momentum happening. As Dr. Kohli pointed out, the real estate cycle had been really bad for the last few years, but now there is some kind of seeming momentum, and they are able to sell flats, and new flats are being built, as you can see from our daily newspaper page 1 advertisements. More projects are taking off, and there is presumably some demand we created with this. So if policy actually gives some support to this signs of economic revival, things can go really far. But again, this will mean large amounts of fiscal expansion. While our space is constrained, I see no escape from the government having to borrow more and then spending more. If they want to monetize they want to borrow from the RBI, I think that is perfectly valid, and that should not be an option that should be ruled out initially. And global capital is available on large scale. Now here again, the one issue is, do our accounting standards, do our corporate governance standards, do our reporting standards inspire the confidence that is required for global capital to flow into Indian projects? This is a very important thing. Yes, we have now adopted global accounting standards. Our accounting standards are now more or less aligned with global standards. But the kind of bank frauds that have taken place, the kind of corporate governance failures that are constantly reported, they suggest that while we have formal standards, in practice, they are not really adhered to. Then there is the government's failure to respect international arbitration awards and constantly challenging them, constantly trying to circumvent them, using legal and institutional means to negate them. That again is something that global capital will find deep discomfort with when it wants to come and invest in India. So these are some issues that the government will address. And I think as far as allowing the small and medium enterprises to get out of their current travail, there are 2-3 courses that are available to the government. Banks only cater to some 15-20% of the credit requirements of MSME sectors. 80% of their loans credit is drawn from non-banking finance companies or other informal sources. But to the extent banks cater to some of their debt, they should be asked to convert their debt into equity, which can again be sold once things are better and companies are in a position to buy back their debt. So that is one way of giving them temporary respite from having to service those loans, which they right now they cannot. Again, large companies which buy from their goods from MSME sector, inputs, raw materials, and so on and so forth, components, they should be asked to buy stakes in the company. So again, they are able to have some respite from having to service their loans. And that can be, the government can arrange for some kind of capital to be given for these companies to take stakes in their supplying small and medium enterprises. These are ways in which you can actually ensure that some capital goes to these people, which is non-debt capital, which doesn't require immediate servicing. And I think this is something that can be attempted. Now, unlike in 2019-20, when, as Dr. Kohli pointed out, there was no precipitate reason why there should be a crisis. And because of the absence of crisis, no remedial measures were taken either. Whereas during the pandemic, because there is distress, the government has vastly expanded the food distribution schemes, the NREGA program. The budgets have gone up, the expenditure has gone up. And the welcome development on that front is that the demand has come down in the last couple of months, which means that people are actually finding employment in agriculture and not necessarily resorting to this dole from the government dressed up as an employment guarantee scheme. So this, some signs of a revival in rural demand, which companies also report, FMCG companies also report, is a positive sign. So overall, we have scope to actually engineer recovery, provided lots of money is funded to help these small and medium enterprises to avoid having to repay or service their loans, which they have probably taken for pure consumption purposes during the period of prolonged lull in economic activity. They need to be given this time and they're given the capital to not have to immediately service those loans, which will actually kill them and finish off last phase of the economy. So I think if constructive action is taken, we can come out of this and still grow at a fairly respectable 7% rate.
Thank you, Mr. Arun. I think you are externally optimistic and internally pessimistic in a sense. So let me go to the next panelist, Dennis.
Okay, thank you, Bhanu. I must say that it was very heartwarming to listen to Dr. Renu's analysis of what would have happened during the pre-COVID period. And of course, some of the policy options expressed by Arun for reviving the growth back to 7%. It was truly a very interesting talk we had been having. Now, I would like to actually highlight a few statistics in order to bring up certain points elucidated by Dr. Renu. See, Indian economy, after achieving growth of 8.3% in 2016-17, it has been sliding down. Starting from 2012-13, the growth was on the upswing. It peaked in 2016-17, then it slowed down. The question is obviously whether this kind of trend noticed, is it structural or cyclical? So this is the context in which I would place the Dr. Renu's exposition in a perspective. Now, looking at the slides and the presentation made by her, it appears that Indian economy is suffering a lot, is ailing a lot due to more of structural reasons. Right now, we know that when we look at the demand side of our economy, we know that bulk of our GDP originate from private final consumption expenditure. More than 60% of our GDP is accounted by it. And therefore, the obvious question is, if at all we have to revive the economy, then what can be done? Can we actually, is there any scope for reviving the private consumption expenditure? So in this context, some of the points brought out by Dr. Renu is worth exploring further. Particularly her exposition, which is rooted in permanent income hypothesis. That is the expectation of future streams of income. Once when that is impacted, then what the households would tend to do, they will actually cut down their current consumption and if at all they carry any liabilities, as the case may, we find in the case of household sector in our economy, they would actually try to retire the debt. So what has happened in the course of even before pre-COVID season, we had, as it was presented by Dr. Renu, the households had actually preferred to retire their liability debt to carrying on with their current level of consumption. So therefore, we find that there is a collapse of the consumption, private final consumption in the economy. As a result of that, what has happened? Then we look at another key component of demand, that is capital formation. We find that that has also collapsed. So one leads the other. So therefore, in the context of ongoing or in our discussion on the growth prospects after COVID-19, what becomes is very important is reviving the demand in the economy. Now, there is an optimism, and we know that according to the recent NSO's release of advanced estimates, Indian economy is expected to grow at the rate of 9.2% in 21-22, as against 7.3% of last year. Now, when we look at 9.2%, it is certainly higher than the peak rate of 8.3, which was achieved in 2016-17. So obviously, there's a tendency for anyone to be very, euphoric about the kind of growth we are reporting. But then we also know that there is something known as base year effect. And therefore, if you actually work out the growth rate, you take the absolute number of 2011-12 given by NSO and work it out on the base year of 1920, then we see a growth rate of around 1.9%. So that means we are still far behind the average growth of 6.6% reported during the 8 years preceding the COVID era. And this year, particularly 2011-12, the expectation of NSO is that the private final consumption expenditure is to grow at the rate of 6.5%, which is less than 9.2% of the overall GDP growth. And since they have given some statistics for the first half and second half of the current year, if you look at what is the growth of private final consumption in the first half and the expected one in the second half, we find that according to NSO's estimates, in the first half, private consumption expenditure was to grow at the rate of 13.5%, and in the second half, it is to grow at the rate of 1.8%. Look at capital formation. In the first half, it is to grow at the rate of 28.3%. In the second half, it falls to 6.1%. So it obviously raises the concern what Dr. Renu says, that is the structural issues is linked very much to the private spending in the particularly consumption spending. Now the question is, if you have to revive the economy, then obviously the candidate will be the private spending or private consumption spending, which also leads the private investment. So now what is the option we have got? In this context, I would like to highlight, yes, obviously, all of us will agree that fiscal expansion is a clear-cut choice. There's no doubt about it. Now, the related question is how this kind of, our planned fiscal expansion will be, accommodated by Reserve Bank of India. Yes, we know that there's no harm, but will Reserve Bank, will our monetary policy be accommodating enough to allow this kind of fiscal expansion to revive the growth? Now, if you look at the process of policy making in the last couple of years, we find that they have certain inflation target, and they look at a band of 4 to 6%. Now, if you look at the recent inflation rate, let's say CPI-based inflation rate, it is still within this band, 4.4% to 6%. At the same time, what we should not ignore is on month basis, it has been rising. Now, it has in the month of December, it stands at about 5.6% combined, rural and urban. If you look at urban inflation, it has already reached 5.8%. So we might actually think that in the forthcoming MPC, which will be convened in February, this may not be considered very much. But then look at the WPA, which also feeds into DCPI. WPA rate has already reached 13.6% in December. Imagine this is against 2% what we had seen in 1 year ago, and this is also on the upswing. Now, if you look at two basic baskets of WPA, that is primary article, it has already reached 13.4%. Fuel and power inflation, it has already 32%. One of the reasons for fuel inflation is they say that international crude oil prices has been on the rise for the last 7 years, and it has reached recently somewhere around $86 per barrel. And when we say that this kind of there is going to be collapse in the prices, one has to be very careful, because for me, since this kind of reaching the level of $86 per barrel was not achieved overnight, rather it has been a steadier rise over the last 7 years. So therefore, I would say that this increase in the international oil prices is going to further feed on to the inflationary trend in the economy. As a result, we might actually soon or later, we might witness higher inflation tendencies. Now, if you look at NSS's estimate itself, And when we work out implicit GDP deflator, it works out around 7.7%, which is way above the upper band fixed by MPC. So therefore, the concern is, if in February, what will be the response of MPC, or how, to what extent, or we will be accommodating any of these expansionary fiscal policies of government? I really doubt it. Now, if that's the case, what would be the option? Even if they have to accommodate, it is going to result in higher rates, interest rates in the economy. And to give you some idea, if you look at the recent activities in the government market, we find that cost of government bonds have been on the rise. Right. All this will point out to the fact that we might be, if at all government has to accommodate, or we has to accommodate, then there will be some amount of increase in the rates. This is what I'm foreseeing. But is that good when we talk about growth recovery? Then the option is, can we think of some options, right, whereby we can think of fiscal expansion without bringing much burden on Reserve Bank of India, which will have to also fight against the rising inflation. So here, there are several options. We talked about it, right? Which can be short-term, medium, and long-term. We can actually commit ourselves to some of the external agencies and bring more discipline to ourselves. All these options are there. But when I was looking at what options available at home, then I find that yes, recently government has been relying too much on indirect taxes. Now, I'm sure that some of the policies of government, as highlighted by Dr. Renu itself, has impacted private consumption expenditure, and one of it is definitely GST. It reduces the propensity to consume to some extent. We cannot deny that. Now, but at the same time, it also this indirect sources have also become off late. It is like it is substituting direct taxes. So in this context, when I see some of these government revenue sources, I find that yes, at one level, we need to follow Keynesian formula, that is go for a fiscal expansion to revive the demand system. At the same time, we should not be constrained to buy monetary policy that I really doubt whether it will continue to remain accommodative. In this context, when I look at this government finances, I find that, look, instead of relying too much on indirect taxes, can we actually look at our own direct taxes revenue? First of all, I would like to highlight the kind of activity that we are witnessing in the stock market during the last 22 months. Though the economy has been, ailing, is enormous. The kind of transaction that is happening is also enormous. At the same time, what is the budgeted revenue from this kind of securities transaction tax? It is a paltry sum of 12,500 crore. So I see that just increase the rate at this point. And remember what Tobin had to say to cut off the speculation. He advocated tax. So why don't you increase the securities transaction tax rate at this point of time and try to realize more of own revenue? This is one thing, so that your revenue will be far higher than what you expected. The second one is, look, when we look at the budget notes, there is a component. We talk about direct taxes raised but not realized. Look at it. How much of money is lying there? And all those people have already provided for it, because anything of the income tax liability will have to be provided. They have provided for it. So why don't we actually improve our tax administration, go for amicable resolution with all the contestants, and at least try to realize a part of it? I'm sure at least 5 lakh crore will be released out of it, right? Realize more of that. The third option, all right, what I can think of is, of course, it is something that Dr. Renu had highlighted, but in my view, it is not something. Me and Dr. Shetty also had written a paper about it in EPW, that is about corporate taxation policy pursued in August 2019, whereby in one go, we said all companies, if they don't claim for any exemptions or relief, they can actually opt for lower tax rate. That is somewhere around 20%. And at that time, the estimate was the revenue foregone on account of this policy was rupees 1.45 lakh crore. We did some calculation. Then we found that this 1.45 lakh was going to wipe out close to 19% of the corporate tax budgeted for that year. See, we are actually wiped now. What is that we have done because of this kind of policies? At one level, we have removed 1/5 of our direct corporate tax. At second level, remember, this kind of tax exemptions and reliefs, these are some incentives in the hands of government. And government, if they lose out this kind of incentive, instead of having them in their hands, if they allow the companies, right, to function on their own, then it's a simple macroeconomic principle that people respond to incentives. Then what's the incentive government has in its hand to actually revive corporate investment? Government in one strike only, it also threw away all the incentives it had in their hands. So what is the incentive now government will have to actually revive corporate investment? So if we actually...
Dennis, we are running out of time.
Okay,
1 more minute.
This is my last point. So in case we actually relook at our corporate taxation policy, I'm sure that a lot more amount of money will be released. These three sources of direct taxes will actually have a far more positive impact on government revenue. So instead of relying too much on their indirect taxes, as well as whether the fiscal expansion as pursued by the government will be accommodated by Reserve Bank or not, we need not worry about it. But through own revenue mobilization only, government can actually revive the economy. I'm sure that in the medium term, right, the situation may not look as grim as what it used to be like last year, but it looks better, right? I'm sure that we'll be able to achieve a higher growth, if not in the immediate future, but sometime. But it calls for re-examining some of the structural process. Thank you.
Thank you, Dennis, for highlighting this tax issues. So now let me go to Radhika. I know she has a presentation. Radhika, over to you.
Thank you, sir. Professor Arjun, can you share my screen, my slideshow, please?
Yes, ma'am, it's on.
Thank you. Good afternoon, and thank you for an insightful presentation by Dr. Kohli and the insightful discussion by the discussants. I will just briefly touch upon some of the points that were raised by Dr. Kohli and the other discussants, and mostly talking about the policy environment that currently exists, and that should shape the kind of responses that are needed to drive a sustainable growth path. Next slide, please. Yeah, so just to a quick backdrop of where we are currently and what happened during the last 2 years, because that will just set the motivation background for the kind of policy responses that are needed. So if we look at the early last year, that is 2021, Indian economy was gradually recovering from the first wave of pandemic, and then we had the second wave, though it was quite severe health-wise, but in terms of its economic impact, the economic impact was primarily restricted to the first quarter, which was the April to June quarter, where we saw a substantial slowdown. And then from July onwards, we saw recovery, and then that recovery continued. Even in the July to September quarter, if we look at the GDP numbers, we saw that we had reached the pre-COVID levels, though there were sectoral variations. So in consumption, we didn't, but in other sectors like manufacturing, we reached the pre-COVID levels. And even after that, if we look at the period post the second quarter, we saw the high frequency indicators were showing a significant rebound, and that led many of the bodies to raise their growth projections for India for FY 2022 and for the next financial year. But then we had the third wave of COVID, and now we are in the midst of the third wave. And it is expected that the damage to it's seen based on international other countries' experience that the damage to life and livelihood is expected to be lower, primarily due to our vaccination, our ability to cope, herd behavior, herd immunity, etc. Next slide. Yeah, so what was the policy response during this period? We saw unprecedented amount of easing of both fiscal and monetary policy, both in India and in other countries. Primarily in India, monetary policy did the heavy lifting in terms of providing credit at eased conditions through monetary policy expansion, through buying of bonds, so that it was easier for banks to lend to other entities, to industries, to MSMEs at lower rates. So we saw a very unprecedented ease monetary policy, which was in line with what other countries had done. On fiscal front, we saw in other countries, particularly in the US, we saw a very massive stimulus in the form of cash transfers and other kind of handouts. But in India, fiscal expansion was primarily targeted because, as we have seen from Dr. Kohli's talk also, that in 2019 also our fiscal situation was quite fragile, and we had to rely on the FRBM amendments to deviate from our fiscal deficit target. So our fiscal position was not as good even before COVID, that we could have embarked on a very expansive fiscal expansion program that other countries did. But then what we saw as an outcome of fiscal expansion in other countries was sudden rebound in demand. So what we are seeing in other countries, and that is now having a bearing on India also through global headwinds, is a rise in inflation. We saw a huge rebound in demand that has resulted in increase in energy prices, commodity prices, input prices, and so on. And that is now leading to an increase in inflation, transmission of inflationary pressures to India, primarily through input costs. So now this is the situation that we are now in, that since the second half of 2021, we have seen resurgence of inflation, which was earlier considered to be primarily due to supply side factors and transitory, but now it is becoming a mix of both supply side and demand side. And the problem now is that both fiscal and monetary policy are running out of the instruments, are running out of the policy toolkit that they applied during the COVID period. So now it's not possible for monetary policy to continue to embark upon the unprecedented easing that it did in 2020 and 2021, because now we are seeing sustained inflationary pressures. So we have already seen signs of monetary policy normalization being done by advanced economies, and even in India, RBI has very subtly started doing normalization through variable reserve repo auction, and that is reflected in rise in interest rates. So we are seeing short-term interest rates have started rising. So the bottom line is that now going forward, we do not have that kind of a space, fiscal and monetary space that we had in 2020 and 2021. And in this backdrop, we have to think about the policy measures, the instruments, the options to think about a sustained growth recovery in the post-COVID period. Next slide, please. So one point is resurgence of inflationary pressure that we've already talked about. The other point that needs attention is boosting consumer confidence. So what we did see during the second half of 2021 was that business sentiment started to rise. And normally if we see, if we superpose business sentiments and consumer confidence, we see that once business sentiments picks up, the consumer confidence also picks up, because business sentiments rises means that companies become more optimistic about employment, they start hiring, and we did see improvement in hiring activity by companies. So we could have hoped that consumer confidence, which was rising, but rising very, very gradually, could have increased, but the third wave has again dented the consumer sentiment. And on top of that, now we have inflationary tendencies that could further put a dent on consumer spending and consumer sentiment. And this is very subtly reflected in some of the data that we have been seeing, especially if we look at the bank credit data. The composition of the sectoral deployment of bank credit shows that it is the retail loans that has been driving whatever tepid bank growth we were seeing. And within retail loans also, it was actually loans against gold jewelry that was rising. So this was just an indication of distressed borrowing that consumers and particularly retail consumers were indulging in, because their incomes had taken a hit during the COVID period. So to ensure a positive growth prospects, a sustained growth recovery, it is important to think about boosting consumer confidence. And in this aspect, it is also important to look at another very important data point, which is labor force participation rate. So if we look at the CMI survey, what we've seen is that though employment has been increasing, but what is very important point is that labor force participation rate has not reached the pre-COVID level. So it's still hovering around 39 to 40%. And this is something which is a kind of a long-term scarring of the pandemic, that people are not even opting themselves to be part of the labor market. So this is something that needs to be addressed as a part of measures to have a more sustained growth path. And given that, we have to recognize that the fiscal space is limited, and as pointed out earlier, if we talk about the fiscal space, and if we follow a more expansionary fiscal policy, that will make the job of RBI as a debt manager difficult, because till now we have seen that RBI has been able to manage debt, government debt at sub 6%. In 2020-21, we saw the government borrowing program was low, the cost was low, but now yields have been rising primarily due to higher inflation, as well as talk by the US Federal Reserve on raising interest rates. So we have already seen an upward pressure on government yields, and in this backdrop, it's challenging to have a very substantial fiscal push through the budget. So the other options could be more targeted spending on the sectors that have borne the brunt of the pandemic, primarily the MSMEs, and also targeted spending to boost employment through Manrega and other such schemes. The other part is the infra push, which the government has already embarked on through a number of institutional measures, as well as through programs like the National Infrastructure Pipeline, National Monetization Pipeline. And now the government has set up a body called NIPFP to mobilize finances for long-term infra spending. So it's very important to mobilize this and to see that it sees the implementation is the key now, because the body has been set up, the board is there, but now how quickly and how efficiently the funds can be mobilized for infrastructure is something to be seen, and whatever impediments are there in this, the implementation needs to be addressed, so that infrastructure gets a boost. And when infrastructure gets a boost, we can hope for higher employment opportunities, higher multiplier effect on long-term growth prospect. So this is a very important step, that some reforms have been undertaken by the government, and these need to be followed by swift implementation and addressing the policy hurdles. On private investment, we still see that it needs a push, primarily due to the last 2 years, we've seen considerable amount of deleveraging by corporates. They have already deleveraged to the extent of rupees 3 trillion. And till now, we don't see private investment picking up. If we look at numbers from the bank credit data, we still see that bank credit to large industries is largely flat. So whatever bank credit is happening, it is either to the MSMEs or to the retail sector. So services and large industries are still languishing in their credit demand. So that needs a pickup. And one of the policy measures is to boost private investment is to have greater policy certainty, policy stability, and measures to ease of doing business, whatever impediments are there. And a lot of steps have been taken to lower the compliance costs, and a more detailed study is required to further provide greater policy stability and to avoid missteps like retrospective taxation and so forth, and also promote foreign investments through both FDI, through the FDI route. The last step, which is more medium-term solution, is to again bring back the financial sector reforms on the agenda. Some of the financial sector reforms were introduced, but then they were put on the back burner. For example, the Financial Resolution and Deposit Insurance Bill, bank privatization was introduced, but it's the next step which requires legislative amendments to to expedite privatization has still not taken place. So financial sector reforms in the form of FRDI, privatization, thinking of some kind of an independent debt management agency, because now it is becoming difficult for the Reserve Bank to look at both inflation management as well as debt management. So all these steps, though it may not show their impact in the immediate term, but they will have an impact in the medium to long term. And these are all productivity enhancing measures to boost growth prospects. So with this, I will stop.
Thank you, Radhika. Arjun, you want to take some questions from the audience?
Yes, yes, we only have one question from Chavi. Ma'am, as per the quarterly employment survey, employment in 9 sectors of the economy showed a spike in July to September 2021 as compared to April to June when the second wave struck. How far do you predict the impact of the third wave we are experiencing right now is gonna be in these sectors? Also, the economic survey for FY20 predicted a V-shaped recovery, but do you see such recovery in the near future, especially after the third wave, or is it still gonna be K-shaped as predicted by many economists? So very general question.
So, Renu, you want to take it? Yeah.
Yeah, on the first one, the quarterly pickup in employment, that's understandable because it's coming from a dip, A, and B, we've also seen a pickup which is mirrored in the data on economic activities, frequency indicators, as well as the high frequency indicators, as well as the GDP data. Both showed, and that's also, there was a huge fallback again in the first quarter, April, June. Going forward, it's hard to predict from there as to what's going to be the evolution. And I think that comes back to your second question, which is about a V-shaped recovery. Yes, a V-shaped recovery, but first of all, there are two things to look at it, and one can look at it in two ways. Typically, after recessions, the springback is usually can be a V or more flatter U and so on. But the point is that the bounce back from a recession, whether ordinary recession or a COVID-induced recession, it typically reaches a peak. And the challenge there is that once that peak is reached, whether that peak is matching up to the previous peak from which growth had plunged in the recession, A, and B, whether growth picks up again from that V onwards or falls back. Sometimes, we can have L, we can have a double dip and so on. So there is, it goes back to the points that I raised about the medium term. So when you're talking about we are talking about the near term, which is a year or less than a year. The challenge is thereafter, what's going to happen thereafter. So that is, as I think, is uncertain, and there is more evidence inclined to suggest that return to a high growth trajectory, return back to a 7%, 7+% path may not be that easy.
Yeah, thank you, Renu. I would like to take a couple of minutes to answer respond to any of the discussants thing. Or
Yeah,
Right.
yes.
yes, please.
I can, yes.
Very briefly,
There
yeah,
are a
already we
couple
are
of
running
things,
time.
and it was very nice. All three panelists, gave very useful comments, and I'm very happy, delighted to, add that. It's flattering, actually. On Arun's point about, there were three things about, one was about deglobalization. I agree with him, and yet I would just point to the fact that deglobalization is or hasn't been any kind of one-off event. It's a process. And one of the things that matter or make look material to me is that post 2010 or 9, that crisis, the increased protectionism and the recovery of world trade. After 2012-13, it has actually, world trade growth has not exceeded world GDP growth. And that has been a trend for almost a decade. So I think that's one indicator that needs to matter. Apparently, in the last 1 year or last several months, it has rebounded. But then again, there is COVID distortion out there. We don't know what portion of the world demand is enduring and long lasting, what portion is repressed and pent up. On the bond market, yes, unprecedented, but that's the pattern of the bond market. 97% of this has been private placement, as in the past. And so, I never build any castles in the air about the bond market, this thing, because as soon as interest rates have started going up, now the corporates have moved to that. And because as long as you are having a private placement and it is permissible, it is opaque, there's going to be no trading, and you will not have repeated issues. It says arbitrage between interest rates that moves from one to the other. And unless you have repeated issues of the same kind and similarity in corporate bonds, you can't have trading. How can you trade? So that's the pattern of the bond market. Last of all, on the capital good, yes, it is true that import of capital goods has risen. And that's where, on the export demand is very important. Long-term trend, we find that there is kind of quite a significant co-movement between the two, just capital goods imports and exports, which is to do with the intermediate into value into exports. The second is that we don't know how much of it is also representing replacement of domestic production. There is evidence to show that because of the unequal recovery and increased inequality, a lot of consumption demand is also being fostered, and some of it may be to do with electronic goods, etc. So that is on the optimism about the scope. Yes, I do agree about all that for engineering or maneuvering a revival. I have a counter question to that, as where will the money come from? And so there, again, we are all very hopeful that disinvestment and asset monetization will yield the extra funds. That's the expectation, including the LIC IPOs, etc. So let's hope that but that's very important. It's critical indeed. On Dennis's remarks about the structural and demand side forces, I'm of course pleased at the agreement on this. Most policymakers refrain from arguing that it is structural. They prefer cyclical. And I remember now, some time ago, what ex-governor Dr. Y.V. Reddy had remarked in the context of structural and cyclical. And he said that politicians like to, or the government likes to think that when it is going up, when growth is going up, then they like to say it is structural, and when it's going down, then they like to say it is cyclical. So that goes back to the policies. And yes, you have given a lot of comments and suggestions on taxation side. I'm not sure anybody will agree with the STT taxation. Any kinds of suggestion, I think even in an editorial would elicit a lot of angst from the public in general, particularly the way in which retail investors have gone into the stock market. And last of all, coming to Radhika's presentation, very nice, and it was a very good recapitulation of the trajectory that we have seen after 20 in the COVID period and beyond, and until now. Beyond, I think we maybe Arjun or Bhanu may want to comment on what or summarize whatever. I mean, if you have a view as to what's going to happen, it would be nice to have the chair, last remarks from the chair on that.
Yeah, thank you. I think we almost exceeded by our time, but I did speak to Arjun, and he said that time is not there's no limit on the time. And first of all, let me thank all the panelists and Renu for making a very exhaustive presentation. I'm sure all the participants would have really benefited a lot from this seminar. And I also sure that you'll agree that you had a very liberal chair, although it was 5 minutes, but I did feel that I didn't want to disturb the flow of the thoughts that you have. And very important points that have come up. First, I certainly would not like to summarize, because it's very difficult to summarize these 4 presentations. So, but first of all, I think we all agree that some part of the slowdown at least is very structural. In fact, one of the few people who think that the slowdown is a combination of both structural and cyclical. And I do believe that it's a combination of both, and you could have a different policy prescription for that kind of a slowdown. And in terms of the structural, I think all of us will agree that the slowdown in the PFCE is a very important aspect. And it has been there even pre-COVID situation, and right now it's actually worsening. And in terms of the investments, I have a slight disagreement with some of you. And if you look at the advance estimate, I think Arun already pointed out, we have seen an investment rate of 36%. Now, it's an unprecedented, if you look at for the past 10 years, when the investment rate has actually gone down to some 22 or 23%. Right now it is to 36%. I think that is one of the important leading indicator for many of us who believe that the recovery is going to be on a durable basis for the next 2 to 3 years. It may not be sustaining for a long, but at least for 2 to 3 years. And I think couple of things which I thought, which was, I think we need to really discuss. It looks like, because we don't have planning commission, we completely ignore or forget the medium-term perspective in this country. And we thought that this 5 trillion economy concept would bring us back to that medium-term perspective. So I guess maybe going forward, we need to bring back this 5 trillion economy for whatever worth it is. Maybe for 10 trillion economy right now people are talking about for by 2030. So in fact, if you want to really achieve 5 trillion or 10 trillion, I think what are the policy measures that we need to have? We need to have a more, I don't have answers for that, but I think that is something that we need to bring back when we really talk about the medium-term growth perspective. Again, personally, for me, more than the fiscal deficit or growth, one of the important aspect, medium-term aspect, is the level of public debt. Again, I'm sure all of you agree that the post-COVID, the public debt has actually gone to more than 90%. Now, our target, as per the Finance Commission, is to bring down to less than 70%. I think that's a very long call. So whether can we stay with this 90% public debt, or we need to really bring back to 70% is something that the policy makers need to really talk about it. And in terms of the external sector, again, I thought one thing that is missing is, the customs or the import tariffs that have been brought back in this country. Somewhere I wrote about it. So one of the documents we successfully removed from the budget documents was the customs tariff lines, and that was brought back in the last budget. And that is the big structural issue that, in my view, Renu, you already pointed out that exports are largely import-led, right? Now, if you're bringing back this customs tariff lines, are we still going to see a robust recovery in the exports in the future? Is something that we need to really think about it. In terms of the taxes, again, Dennis made a very passionate call on increasing the corporate taxes, and all those things are the direct taxes. But I think we also need to keep in mind what is the net impact of this reduction in the corporate taxes. Whether it is going to increase the tax revenues or it's going to reduce the tax revenues. It's again an empirical question, and we also need to keep in mind what happens to the external competitiveness. I think those are some of the things I thought I'll bring it to the table. But in terms of the fiscal space, I am little puzzled. For 2021, our general government fiscal deficit was somewhere close to 15%. Okay, and now for the current year, it is going to be somewhere close to 10.5%. We have done so much, I guess, when it comes to the fiscal policy. If anybody says that government has done less, I still have my own reservations on that. There's no country which has given 15% fiscal, which is running fiscal deficit of 15% or 10% for the current year. And in terms of MSME, again, I completely agree with all of you. But if you look at even some of the schemes that have been brought for the MSME sector, actually the data says that they could not really release the funds. The 3 lakh crore that has been allocated for MSME under the Atmanirbhar Bharat is just around 2 lakh crore has been disbursed for the past 12 months or so. So these are some of the things that I think we need to really think about it. In terms of private banks, I think Radhika has again very passionately came out with this private banks issue. I'm not really sure whether we need to have less public sector banks or more public sector banks, especially when we have a very long way to go in terms of financial access or financial inclusion. Particularly when the size of the rural economy is increasing, what is the role of public sector banks is something that, again, we need to, it's very easy to say that, yes, you need to privatize, but can the private banks take the same role or place of public sector banks, especially in the rural areas? In fact, one of the biggest success story in the recent period is the DBT. Now, if you look at the DBT, what is the role of private sector banks? I think these are all empirical issues. And CPI versus WPI, Dennis, again, I'm with you on this. Empirically, there should be a co-integration, right? There should be a co-integration with a lag of 1 month or 2 months. Now it's more than 9 months or 10 months. So in that sense, one of them must be wrong, right? I don't know. Or something must be happening between the wholesale market and the retail market.
Demand.
Well, I don't know. I'm talking since Dennis looks at the numbers a little more carefully at the ground level. The fact that we get the wholesale market price index much later than the retail market prices. So I don't know how much importance the data generating agencies actually giving in terms of WPI coverage or WPI collection. I think, I completely forgot to look at WPI numbers for a long time. It's a very old 2011, I guess. 2004-5, I guess. And it doesn't cover the service sector, so it has its own limitations. So, and in any case, we have adopted CPI as a policy anchor, right? I think, so there are little disagreement on that, but otherwise, we have been talking about this divergence for a long time. And overall, I must say that I certainly learned a lot today, and I would like to thank IMPRI for giving me this opportunity to chair this very interesting discussion. So thank you so much, and over to Arjun.
Thank you so much, sir. So to officially propose a vote of thanks, now I invite Dr. Simi Mehta. Over to you.
Yeah, thank you. Thank you so much. It has really been very enriching. And as we stand together in unity and in solidarity of a strong and resilient Indian economy, this deliberation has truly been very insightful. And it has very richly contributed to the policy and structural measures that need to be undertaken by the government. So I would like to formally propose the vote of thanks on behalf of the IMPRI Center for the Study of Finance and Economics to our distinguished speaker, Dr. Renu Kohli, and to our distinguished discussants, Dr. Radhika Pandey, Dr. J. Dennis Rajakumar, and to Mr. K Arun. And thank you so much for adding to the discussion. I would also like to thank Professor N R Bhanumurthy for agreeing to chair the session. So thank you. You have really added to the intellectually informed discussion that has taken place today. And lastly, my deepest gratitude to all the participants here on Zoom and also on Facebook Live, and to all those who would be watching us later on our YouTube channel and listening to the podcast on different platforms. So thank you so much, and we look forward to continuing to learn from you. Wish you all a very, very good day, and please stay safe. Thank you.
Thank you so much. Thank you, everyone.
Thank you.
Yeah.